Why are some traders consistently better at timing their entries and exits than others? The secret often lies in a powerful tool called technical analysis. If you're trading on platforms like Newton, you'll have access to charting tools that help you see the story the price is telling. Today, we're breaking down three foundational concepts: support and resistance, the simple moving average, SMA, and the relative strength index, RSI, and how you can use them together to inform your trades. Support and resistance, the price boundaries. Think of support and resistance as the floor and ceiling of a price chart. Support is a price level where buying interest is strong enough to overcome selling pressure, causing the price to stop falling and reverse. It's the floor that holds the price up. Resistance is the opposite, a price level where selling interest is strong enough to overcome buying pressure, causing the price to stop rising and reverse. It's the ceiling. When the price approaches a support level, it's often a potential buy signal for traders betting on a bounce. When it approaches resistance, it's a potential sell signal. The more times the price touches a level and reverses, the stronger that level is considered. When a price breaks through a strong support or resistance level, it often signals a major shift in the market trend, and the old resistance often becomes the new support, and vice versa. Simple moving average, SMA, defining the trend. Next, we have the simple moving average, or SMA. This is a line that plots the average price of an asset over a specific period, like 50 days or 200 days. It literally smooths out the price fluctuations to give you a clearer view of the underlying trend. If the price is above the SMA, it generally suggests an uptrend. If the price is below the SMA, it suggests a downtrend. But here's where it gets powerful: the SMA can also act as dynamic support or resistance. In an uptrend, traders often look for the price to fall back and bounce off the SMA, which confirms the trend is still strong and offers a good entry point. For short-term traders, a shorter period SMA, like the 20 period, is more responsive, while longer periods, like the 200 period, are better for identifying long-term trends. Relative Strength Index, RSI, measuring momentum. Finally, let's look at the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. It moves between 0 and 100, and its main job is to tell you if an asset might be overbought or oversold. A reading above 70 suggests the asset is overbought, meaning the price may have risen too fast and is due for a pullback or reversal. This can be a potential sell signal. A reading below 30 suggests the asset is oversold, meaning the price may have dropped too fast and is due for a bounce. This can be a potential buy signal. The key is to use the RSI to confirm your support and resistance levels. If the price is at a strong support level and the RSI is simultaneously below 30, that gives you a much stronger signal for a potential buy. Likewise, if the price is at a strong resistance level and the RSI is above 70, your confidence in a potential sell signal should increase. Using these three tools, support and resistance to map out price boundaries, the SMA to confirm the trend, and the RSI to measure momentum, gives you a strong framework for making more informed trades on your Newton platform. With that said, thanks for watching, and until next time.